So welcome everyone to the webinar. Thank you so much for coming. I want to start off with doing just a little bit of housekeeping first. So I have a whole bunch of technology in front of me. This screen right here to my left is the same screen that you are seeing. So if I'm not looking at you, you'll kind of know what I'm looking at. And this screen to my right controls my notes and the chat and all the logistics behind the webinar. And then I have another one sort of down below, which shows me what you are seeing to make sure there's no technological issues. So there's an awful lot going on here, but I don't let that distract me. So I just wanted you to let you know what I was looking at when I'm as I'm going through. So let's just get started. All right. So I see we have quite a few participants here, and some people I know and some people I don't. So I want to tell you perhaps just a little bit about myself so you know what the history is for those people that don't know me. And for just over 10 years, I owned a professional bookkeeping and accounting firm, saw hundreds of clients, really been able to do a lot of the coaching. I didn't really do a lot of the work in the last 5 years, so a lot of what I did do is teach and educate customers about how you do all the right things in your business. So now I've sold that business and here I am, and this is what I do full time. I teach and coach and educate. So that's about me. What I'd kind of like you to do, I have a little chat thing here that I'm monitoring. What I'd like you to do is check in about you. It'd be really cool if you just put in the chat sort of what your business is, or if there's anything that you really wanted to know while you're here. That would be super cool. I'm always looking to know who it is that we're chatting to. Today we're going to talk about the differences between how you get your money out of the company. There's a couple of different ways, and it can be confusing for both new and seasoned business owners about what the how and the why. And I've even seen some people who have been in business for a while and they still don't have the answers right. So it's a confusing journey. So if you're feeling like this is an area that I'd really like to know about and I don't know much about it, you're certainly not alone. So we're going to talk a little bit today about how the different choices that you're going to make affects you in things like workers' compensation, CPP, RSPs, disability, etc. So we're going to cover all of that, and we're going to cover also, not on here, a little bit about why the tax is different and how it's different. This course is for incorporated companies. So if you're a sole proprietor, most of the information here is not going to apply to you. But if you're looking at incorporating, just hang tight. You're going to find a lot of good information coming your way. I always make sure when people, you spend your time, which is valuable. When you are spending it, to spend it with me, I always want to give you a bonus at the end. So right at the very end of this webinar, I'm going to give you a free course, which is actually going to help you a little bit about doing your own books and putting things together. So stay tuned. That comes at the very, very end. One of the things that I need to say is tax is a complicated area. And so I want to put a disclaimer up that anything that I say here is very general and it's for information purposes, but everybody's tax situation is different. As we go through this, you're going to see a little bit, you're going to be kind of confused, like, I thought she said, or what happened? And that's because a small variance in your tax situation can make a huge difference in the result. So always consult your accounting professional to make sure that you have the right answers. Also, we're going to talk a little bit about workers' compensation and disability, and you need to talk to the appropriate professionals in that area too to see if what we're talking about really affects you. This is very generalized, and it does affect most people for sure. I would say, the majority for sure. And it's current as of today. One little note, as of today, tax laws change, and they change often, and so do rules, and there's a lot of moving parts. So if you ever hear the words federal budget or provincial budget, that's a real good check that maybe something is changing. Okay, so why care about how you take your money out of your company? Isn't that your accountant's job? Well, not really. So a lot of solopreneurs or small business owners, they just kind of go with the flow with whatever their accountant tells them to do. So the accountant, you take your books to the accountant gets them, he or she will do it. They tell you, we're going to give you a dividend of X amount of dollars, and you as the business owner go, Well, okay, you're the accountant, right, in your mind. That's good. But that's not always the best way. The way that you pay yourself is kind of chosen by a default method by the accountant, because you've given him really nothing else to work with at that point. How you pay yourself impacts your taxes, and it impacts a lot of other areas of your life. But the problem is, if you only do it at the end of the year, when your year end comes up, you're only leaving your accountant with one penalty-free option. So that's dividends, and that becomes the default. So a lot of people will actually end up doing dividends, thinking it's in their best interest, but it isn't always really. So we're just going to visit about paying yourself as a sole proprietor. But I know I said this wasn't for sole proprietors, but you got to understand one little concept about it before we go on. So the sole proprietor is pretty easy. We all started there, right? And then we move on to become an incorporated company. So the profit and loss sheet is for every business has a profit and loss at the end of the day. And a sole proprietor works super easy. So you get the whole thing at the bottom of at the bottom. So down here, this blue arrow is, there's a line which says that's how much money you made. So in essence, it's money minus expenses equals profit. In a sole proprietor's case, that number becomes the number that you are taxed on. Now, that's a little different as an incorporated company, because as an incorporated company, you have this magical line on your balance sheet called a shareholder's loan. Let me explain. So a shareholder's loan is the amount of money that transpires between you and your company. So when you take money out, your bookkeeper accountant calls that a shareholder's loan. You're a shareholder and you got a loan from the company. When you do the shareholder's loan, the tax, the amount that goes into the shareholder's loan becomes the amount of tax that you pay. In a corporation, tax is a little bit more complicated in that you have two taxes that you have to worry about now. You have the incorporated tax, which is known as the corporate tax return, which is known as the T2, and you have the personal return, which is known as the T1. So if you're already feeling confused, just hold on. We're going to get to some of the detail here. Just a moment. I'm just going to fix my little technology over here. Okay. So the balance sheet is a statement that every incorporated company has. Now, if you don't know what a balance sheet is, part of the course that we're going to introduce you to at the end is a course called eSchool. And eSchool is about 12 modules. And it basically explains a whole bunch of the pieces about those fundamentals of business. For this webinar, I assume that you know what a balance sheet and a profit and loss statement is, but if you don't, we cover a whole module of it in eSchool, so you might want to check that out, and that'll help you understand what this really ugly looking and kind of complicated looking sheet's about. It's not that hard, honestly, not that hard. You just really need to know it. So the shareholder's loan appears in this liabilities section of your balance sheet. Now in this particular case, and I blew up here what's in red, in this particular case, the shareholder's loan is minus $11,036. Now anytime your shareholder's loan is in a minus, that means it's too much money that you took out of the company. And it has to be dealt with at the end of the year when your accountant gets it. So the process that's really happening is that you take money out, it goes to the shareholder's loan, the accountant does your year end, and then he sees your shareholder's loan as a negative and he says, I have to deal with that. And that's dealt with through a dividend traditionally. Now, it doesn't have to be dealt through a dividend. It can be dealt through other methods, but that's what we're here to talk about. There are two general methods, and that is basically paying yourself as an employed salary, a salaried employee, or as dividends and as shareholder. They are vastly different, but you have a choice. What you need to know, though, as we walk through, if you want to do yourself as an employee, you have to be proactive and not reactive. So doing yourself as an employee is a proactive measure. Paying yourself as dividends is a reactive measure. So, excuse me. Each method, they're not the same. It's not like saying you just get money. In the eyes of Revenue Canada and in the eyes of your accountant and certainly the amount of tax you pay, they're not the same. And there's lots of other benefits around it, which we're going to talk about. One thing to make note, if I had a nickel for every time I heard my buddy takes dividends or my friend does this, I would be a rich person. And I got to tell you, here's the situation. Your tax profile is not the same as your friend's tax profile. One small change, for example, being married or having a child or having another job, can change your whole tax landscape. So your situation and your friend's situation, not the same situation. So you really need to make sure that you hear that and go, but the right one, there's no blanket one for everybody. I'll give you the pros and the cons a little bit later. The right one is the right one for you and your tax situation. Even something as simple as having a spouse that doesn't work or a spouse that has low income, that can totally change it as well. So the very first area I want to talk about, which is affected, is the Canada Pension Plan. So the Canada Pension Plan, I just need to move this. The Canada Pension Plan is, in a case of payroll, the CPP is something that you pay for 47 years. And then when you're retired, you get that money. Now, right now we're sitting at about $1,100 a month, just over $1,100 a month. So if you retire at the age of 65, it's not a lot of money. So a lot of people think, well, you know, the CPP won't be around when I get there, or I have other savings to do, which is fine. We'll talk about that a little bit later. But the reality is that there are other benefits to CPPs beyond the retirement. Everybody knows about the retirement. There's a couple of other ones. There's death benefits. There's death benefits for your children in case something happens to you. And there is disability benefits. The big one that I always tell clients about is disability benefits. And why? As we age, disability becomes a real possibility. And if you're going to try to buy disability insurance, let's say at the age of 50, A, you may not be able to get it. So disability insurance typically is something not to qualify for. And B, it's really expensive. So you have to have something in place for disability. Well, this is where the Canada Pension Plan comes in. If you are disabled to a point where they call it debilitating, then what happens is that they give you a disability pension for the rest of your, for as long as CPP takes care of you, which on most people is the rest of their lives. So the disability, though, if you do not take payroll or if you are not contributing to CPP, you do not qualify for disability. Now, there's a 6-year time frame that happens in. I think I actually have. I'll just drop to a different screen here for a second. This is direct from the Canada Revenue Agency site. The contribution requirements to be eligible is 4 of the last 6 years, or if you've contributed more than the last 25 years, 3 of the last 6 years. So what that basically means, if you're paying yourself as payroll, you're contributing to CPP, no problem. But if you're paying yourself as dividends, you are not contributing to CPP. So this story here, where you're contributing, you're not contributing. There's no contribution happening. So if you're a company that consistently takes dividends year after year after year, and you were injured or you were disabled or you caught one of the big things like cancer or Alzheimer's or something like that, you would not have government funding for your disability because this part does not qualify. So, and that's kind of alarming to some people, and there's a way that you can still stay qualified for that. And we're going to talk about that right at the end. So you can still stay qualified and still take dividends, but you've got to intentionally do it that way. Okay. So if you're taking dividends again, there's no benefit whatsoever. And if you don't have any retirement savings, it can certainly be detrimental to you and for both retirement and disability. Okay, so let's move on. We talked about how important CPP. So let's look at workers' compensation. Now, I often, because my program is Canadian, I often get people outside of the province of Alberta, where I live. So I want to be able to say this piece is for Albertans only. I don't know the WCB in your particular province. It might be the same, it might be different. What I can tell you is it's worthy to make the phone call and check it out and see. So in Alberta, workers' compensation has different kinds of coverages for employees and directors. And then within directors, there's also a different kind of coverage. We're just going to talk about the directors side of it. So when you pay yourself as an employee, as an employee of your own company, you have WCB coverage for whatever you're earning-ish. So as a director, there's a minimum and there's a maximum. The minimum is right now just over $28,000. And I believe the maximum is about $96,000 you can insure yourself for. So let's say you want to insure yourself for $50,000 a year. Easy to do as a director, so you simply just tell them, that's what I want to be insured for. However, if you were ever in a place where you needed to make a claim, you needed to prove to workers' compensation that you were getting your earnings by way of payroll. And they will ask for proof, and usually they ask for an accountant's letter saying that they are satisfied that you've been remitting to CRA regularly and that you are paying salary. So in that particular case, if you want to maintain your workers' compensation, it really requires you being diligent about taking payroll, which usually in most cases means you're sending in regular remittances to the government on a monthly basis. And then you can say, this is my remittance, this is what I've got, you know, ouch, I'm hurt, please process my claim. If you're taking dividends, you don't have entitlement to that claim, even if you pay for it. Now that's an important note, especially if anybody here is in the trades, you know, where your likelihood is getting injured more, and a lot of people in the trades insure themselves. If you are taking dividends, you are not entitled to the workers' compensation at the rate that you dictate. You are entitled to the minimum, which is $28,400. Now, unless there's been a change with workers' comp, I always encourage you to make sure you call workers' comp and check with them on your particular account and how you've got it set up. But that has been how it's worked for a number of years. When you're a director of a company, you get this thing called director's coverage. And even if you are taking dividends, you're still entitled to the director's coverage, the minimum director's coverage of $28,400. So you need to understand how important is workers' compensation in my equation. And if it's important to you, then you need to make sure that you are paying yourself appropriately in order to match what you're telling workers' comp that you're actually doing. By the way, not sure if you know this has really got nothing to do with your pay, but when you're on workers' compensation, if you're insured and injured for $28,400, that's all you can make. So let's say you're injured and you're rehabilitating and you make some extra money by working at a grocery store or something. I don't know. Some job where you just want to get out of the house and get a couple of hours and start to move around a bit as you heal. Whatever money you make at the grocery store will reduce the amount of claim by $28,400. So that $28,000 is what you're allowed to make as income for the time when you're on workers' comp. Just kind of an interesting note that people also usually don't know. Nothing to do with the way you take your money out, but a good point to check with workers' comp. So you really need to measure in and check to say, you know, how important is workers' comp in my life? Is it an important equation? And if you're in a job which is potentially a little bit more risky, you may want to look at that a little bit differently. So RSPs is another area that's affected. So the RSPs, the way an RSP works, every year when you file taxes, your contribution level goes up. So you're allowed to contribute more to RSPs. The way that number is determined is it's roughly-ish, it's whatever money you make, it's 18% of that money. So if I make $100,000, my RSP contribution level goes up by $18,000, 18%. Which is good. If you have RSPs as part of your retirement strategy and you're investing, you of course always want that contribution level to go up so that you always have room for the room to be able to contribute. So this is a question you have to have with your financial planner and however you're doing all of your investing. Now, those contribution levels only go up when you are a salaried employee. So you have to pay yourself as T4 earnings for that amount to go up. As a dividend, you get no addition to your contribution level. With your RSPs, it doesn't affect it whatsoever. So again, if RSPs are part of your retirement strategy and that's where you're contributing, again, you have to have it in the payroll side of the equation. So talk to your financial planner and really figure out, is this part of my retirement strategy? Because if it is, you want to look at that a little bit differently. If you're a high earner, by the way, just a real quick note on the RSPs, if you're a high earner, you might want to ask your accountant about an IPP, which is an individual pension plan. Sometimes people who have companies and earn a lot of money take advantage of that, which completely outside of the scope, just a total side note. Okay. The last area which is really affected by how you pay yourself is your disability insurance. I am not an insurance broker. I don't sell insurance. I'm not licensed to sell it. So this is not an insurance conversation. But what I do know after seeing many customers is that when you move from an employee status to a dividend self-employed status, your needs and requirements for your disability insurance change. Some disability policies will say, we will pay you 66% of your earned income. Now, earned income, employment income, payroll income, those are all T4 slips. So sometimes what happens is we buy a disability policy when we're employees somewhere because we think it's a great idea. It is a good idea, especially if you buy it when you're young. But when you become self-employed, your disability requirements change, especially if you pay yourself dividends. Now, I'm not saying all policies are like that. What I'm saying is you got to check in with whoever sold you, your broker that sold you the policy, and say, you know, I'm now paying myself dividends. Am I still covered? Like, what's the criteria? And I'm going to give you a tip, and I know a lot of people that sell insurance, so I might get myself in trouble for this, but I'm going to give you a tip. And I give you this tip because I've seen this one live happen firsthand. You need to have your broker pull out the policy and highlight the line for you in yellow highlighter, which says how they're covered. Disability insurance, you buy a product, your broker makes commission money, and then he moves to the next client. Nobody really is reading that really thick book that you get and reading the fine print. But the reality is, if you're injured and you're not covered, you can't say, my broker told me I was. So sometimes the brokers don't know what the coverage is or how you're paid. So you need to get into that policy, that really thick book, and find the words which says what is the payment based upon. And kind of the rule of thumb-ish is that if you chose the amount, you're usually covered. But again, I'm not an insurance person. What I know is I've seen many people have to change their disability policy when they have been incorporated and they're taking dividends. So you just need to make sure that you check that. Okay, so we've been talking about payroll and dividends, and I just want to do a quick check here because we have a question about dividends. And so dividends are, I want to define a dividend. And dividends, when you own an incorporated company, you own the shares of that company. And I'm not going to get into how that works. If you're interested and you need to know more, we cover that in real nice, simple detail in our course in one of the very first modules. And so you hold these shares in your company, and the shares have a value in the same way if you go to the stock market and your shares have a value. It's kind of the same thing. So a dividend says you have X amount of shares, we're going to pay you whatever those share value happens to be. So a dividend is more on the share aspect. We don't go into that definition here because I think probably most people in here understand that piece. But certainly if you don't, I welcome you to jot into the course and take a look at it there. So dividends is paid, it's in two parts, and it's really important to understand how the tax is paid. There's this really complicated thing called the dividend tax credit that we do not get into either here or in the course. That's up to your accountant because it's really complicated. But the dividend is paid in two parts. Because of that dividend tax credit, part of it is paid in your business and the remaining part is paid in your personal tax. So sometimes when people file their taxes, they go, whoa, that's a much better tax rate, I'm paying that. But they didn't realize they already paid the same amount of tax or close to it in their business. So dividends feels cheaper because it happens in 2 different places, and it can happen in 2 different times. So for example, let's say you have a July year end. Well, when you pay your tax for your company, you're paying that, let's say, in August, and then you pay your personal tax for that same money, you pay your personal tax in April. And most business owners don't put that together, that, oh, I paid half in August and I paid half in April, or roughly half-ish. So it feels like it's cheaper, but it may not be. It actually, there's a tipping point where dividends actually become more expensive. So you have to kind of watch that, but that's what it feels, that's why it feels different. CPP is the other place. The Canada Pension Plan premiums only occur on payroll monies. They do not occur on dividend monies. So you save yourself, which right now is roughly around $5,400 a year. It goes up. The federal government has proposed some changes which will push that up even further, and significantly so in the next couple of years. However, for today, it's right around the $5,400 mark. So if you're taking dividends, you actually don't pay about $5,400. So I want to kind of try to compare that for you here. And let's just look at this chart right now. This is a really good calculation to do with your accountant. So the first one on the left-hand side here, we have example, you're paying it as payroll. So there's nothing paid in your corporation. It's a full deduction. You're not paying any part of the tax of that money in your corporation. So you take the full hit of it personally, and that happens on your tax return, which you should be doing right about now. I'm just using some fake numbers, $20,000, let's just say. So I paid $20,000. I paid myself as payroll. I did my taxes in April. I paid $20,000 plus there was an element of CPP which was paid. So the total amount of payroll, the total amount of taxes on the left-hand side is $25,400. Now, let's assume the numbers are the same as a dividend and the taxes are the same. The numbers, by the way, are not going to be the same. If you made $100,000 in payroll, the tax numbers will be very different as $100,000 as a dividend. However, for this particular example, we're going to use these numbers. So as a dividend, the amount of tax paid in your corporation is the first roughly half-ish. And then the balance is paid on your personal. So the total tax paid is $20,000. So the tax is roughly the same. And only for this example, I'm saying the tax is roughly the same. It may not be. I just wanted to keep it simple. You pay no CPP premiums, so the total taxes paid are $20,000. So that kind of tells you a little bit of the breakdown, sort of where the tax comes from each place. And you can see why dividends, certainly if the amount paid in your corporation in the very first part, if you paid that way back in, June or July or August, and then you pay the balance in February, that might seem a little bit weird. And certainly it would be hard to connect. Okay, so if you're paying yourself as an employee, the amount of payroll is sometimes paid to you as one huge lump sum in December. So right before the slips for the year are due, and all the slips for the year, no matter which one you're filing as, are due at the end of February. Now, if payroll is your strategy, I always suggest you pay it in monthly increments for a couple of reasons. Number one, once you start paying payroll, you have to pay something to Revenue Canada, or you have to do this thing called a nil return, which I'll talk to you about in a minute. It's regulars. CRA can see that you're paying exactly what you're paying. They have some exposure to it. Once you start the payroll, sort of puts you underneath that radar, I would think. The other piece is workers' comp, if that was important to you. Based upon what I know about workers' comp, I would certainly want to have regular payroll being sent into Revenue Canada so that there's no dispute about how I was paying myself. So if you do it in monthly installments, you're sending your deductions, the CPP and the tax. Business owners are EI exempt over to the Canada Revenue Agency. And from that point forward, from the first time you do that, you now need to make sure that you're sending them something every single month. Now, there's a little thing called a nil return So, and you have to log online to do it. So if you don't have your CRA account already established, where you log online to the CRA, you really should get that done. We have a module that's coming up pretty quick. It'll be released soon. And it shows you how to get that account set up. We do have some of the Revenue Canada stuff in our course right now, so you don't have to search through their site how to do it. But we do have something coming up on that in our course, hopefully soon. But you would basically, the process to set up an account, you set up your personal account, and once you get that all set up, then you connect your business account. You connect it by using that 9-digit number that the CRA would have sent you. However, the point about this is that when you log online and you submit a nil returns, you're saying, I know I did payroll, but I have no more payroll until a certain date. So you can say till December again, or whatever, whatever your strategy is. Then what happens is that your company issues you personally a T4 slip by the end of February. And that typically, I mean, you could do that process yourself, but it's not something that you want to go wrong on, because if you do it wrong, there's penalties and interest on it. So it's typically done by your bookkeeper, or sometimes accountants will do it as well. Okay, what happens if you're paying yourself as a T5? So what happens is the dividend is issued to the shareholder. Okay, so I own the shares, I get a dividend on my shares. It's normally done from your account at the time of your year end. Now, this is an important point. We're going to go to another slide here in a few slides away, and I want you to really take note of this. It's done at your year end. So if your year end is July, your accountant does it with your July taxes. He declares the dividend and he says, this is what this person's going to make. But that paperwork does not get sent into Revenue Canada until February of the following year. Now, this is when we get to the slide about talking about the tax timeline. This is actually a really important note to think about. There's no CPP, so there's no remittances or anything. And the personal tax calculation's not the same. So if you ever see something about personal tax, it's not quite the same. This dividend tax credit really confuses it. We don't cover that here, but I just wanted to say it's a different type of tax calculation. And again, we talked about this last point where people often see dividends as being cheaper, but in the reality, they're not always. Okay, so dividends is quite common. Excuse me. It's quite common amongst business owners. And the reason it's quite common is because if you didn't look after your money, if you didn't make a decision about what it is that you're going to do, you really left your accountant with one option at the end of the year, just one. Now, he could still pay you payroll, but it's not penalty free. And when you think about what the penalties are around payroll, it's sometimes can be pricey. So you give him one option, that's dividends. It doesn't mean it's the best option. So if you're not doing anything and you go to your accountant and he gives you dividends, he doesn't say to you, I'm giving you dividends, but you have no CPP and you have no workers' comp and, you know, he's not saying those to you. So it could really affect everything that's happening, in your outside world and the workers' comp, etc. If he is just giving you dividends and you're not even really knowing that it's affecting that. So one interesting note that is kind of happening in the industry right now, we've heard about all these tax changes, and in fact, we didn't even know what they were. And recently, just before we did this webinar, we had a federal budget which has defined them. And I haven't really investigated or done taxes around that budget yet, so I don't know that I'm in a great position to tell you how that's affected. In prior years, there was a bigger benefit to dividends, and that's lessening over time. In 2016, I think 2016, there was a huge change in the provincial budget here in Alberta, and all of a sudden, accountants were giving business owners huge amounts of dividends because the tax implication after that year was going to be pretty large. So dividends, if you have a dividend strategy or even a payroll strategy, it's something you need to check in every single year and talk to your accountant. And if you're real good about it, real smart about it, you're going to check in December. Regardless of when your year end is, at the beginning of December, you call your accountant, you look at your shareholders loan, and you say, I've taken $100,000 from my company so far. What should I do? If you don't do it in December, then your accountant has no time to make any other choice other than dividends. So that's what the time when you have to check in and make a decision about what you're doing or how you want to proceed. Changes every year, and if you ever hear the word provincial or federal budget, you know for sure that's a phone call to your accountant to say, I'm checking in. How does this affect me? Okay. So I always talk about CPP and not having, you have to retire somehow. And I'm certainly not a financial planner of any nature, but I always say to people, you know, we did this chart about how much money you would have if you took your CPP premiums and invested them. And I think if you invested them at the age of 25 or 30, you ended up having about $800,000 when you retire at a rate of about 6% return per year. So you really should do something. And it doesn't really, it's got nothing about how you take your money out, but you have to remember, if you don't believe in CPP and you don't believe that it's going to be there, then you have to have an option. So a caution about timing. Remember I said this is really important, pay attention. I am going to show you how timing works and how this catches business owners off guard all the time. It normally won't affect you if you run your business day to day, but here in Alberta, we had a bust in the oil industry, and people would come in to get their taxes done and owe huge amount of taxes, and they didn't even have a job anymore. And not only did they owe taxes then, they owed another similar situation the next year it was coming. So this tax timeline is why this happens, and I want you to be cautious about where your year end is and how this is going to affect you. It's a little bit confusing, so I strongly encourage you to do a screenshot or do something to take this particular page and take this to your accountant and say, tell me how this affects me, so that you know, even after you go out of business, or if you get a big contract and then you don't have, or you know, those big fluctuations in your income, you might be surprised at the tax bill you get, and it's not always a good surprise. So in this particular case, let's look at February. If your year end is February, do you remember I said the accountant does the dividend at your year end? So the accountant does the dividend in February. So they have decided what they're going to give you for dividends, and the accountant doesn't look at your stuff again until next year. So he's got a dividend piece of paper, and let's say there's $100,000 of dividends, and he's like, that's what I need to give him, and he holds on to that. The following February, he files that with Revenue Canada, okay? He's done nothing from March, April, May, June, July, August, September, October, November, December, nothing with those books. So you've been taking money out of it, and when taxes comes, you're paying tax on this February dividend that he's declared, okay? And then you pay tax. So everything between March of, in this example, 2017 and April of 2018, he's going to look at in February of 2018. Same thing. So if February is your year end, you're doing your taxes right now, he's going to say, this is my dividend. I'm going to take this. And he's going to hold on to it. He's going to completely ignore you for the rest of the year. And next year in February, he's going to file this dividend with Revenue Canada. So whatever money he declares in February is going to be what you pay taxes on next year. So if anything happens between March and December of this year, you're actually going to be paying taxes on that way in the following year after that. And it could be potentially in 2020. So you need to understand the tax implications. When it feels like, oh, I'm not paying much tax, just know you might be paying the tax on all of the money you're putting in your pocket in future years. The earlier your year end is, so January, February, March, April, May, the more you're going to feel that impact. The later your year end is, so September, October, November, December, the less of an impact you will feel. So hopefully, we do explain this, by the way, in Module 12 in our course, which is Your Money. We give this a little bit more attention, but I only have an hour, so just know, print this and take that to your accountant, do a screenshot right now, and have a conversation with them so you know where you stand in this equation. Okay, Canada Pension Plan premiums, we're just going to revisit. Some people say, well, how do I know? Super easy. You go to canada.ca. And you will, when you get there, you get this screen. It says My Service Canada account here on the right-hand side. Once you get logged in, and if you might have to go through the whole login process, but once you're logged in, it looks like this. There is two here, which are kind of important. This controls your CPP and your EI status. So the CPP contributions here and the estimated monthly. So this one here is a CPP contribution. So this says in every year that you worked, these were the contributions that you did, and here's your pensionable earnings, which is kind of like your salary, but not always, not really. And then this is the amount of money that you contributed. And it will list from the time you started working all until today. So you can keep going and see how much you have contributed to CPP. The other one, which is this one right here, the estimated monthly CPP benefits. The other one looks like this, and it says, if you retire today, this would be the amount of money that you would receive. So right now, the maximum pension that you would get is $1,134.17. If you retired today, if you were 65 today, this is the amount of money you would get from CPP. And if you did this at 60, this is the amount of money, and at 70. So that's always kind of an interesting piece to know. A lot of people don't know this actually exists online, but you can absolutely register for that. So I want to show you a couple of resources here. And I always say, you know, I have 1 hour to do this webinar, and I could talk forever. If you know me, you definitely know that. So the amount that you need to learn, honestly, is hard to be done in an hour, but with a few hours, it can give you some really good guidance. This particular product right here, I want to offer you as a resource, is something called eSchool. Now, here are the 12 modules that are in eSchool, and they cover everything from being in business, the fundamentals, the personal taxes, the basic financial concepts, your money, how you kind of put your books together, and how you read financial statements. So this is a really nice walkthrough. You don't have to take it in order, so you don't have to go 1, 2, 3, 4. If you wanted to know basic financial concepts, boom, you go to Module 9 and you do Module 9. There's also, and this particular course, it's $297 for this. We always offer a webinar special, always. So this coupon, our courses are 30% off when you take a webinar. So you would just use this coupon, and you don't need to scribble it down. It's going to come out in an email to you shortly after this webinar is done. And if you wanted to save roughly about 89 bucks, you could register in that course. There's also a live and online version, and the live and online version has some very set dates, and I think the next one's starting at the end of, at the beginning of April. And what it is it is 6 series with me. So we do 6 series once a week. Then I teach the material, so we open up the webinar a lot more, and you can chat, you can ask your questions, and you can have a reply to me. The courses are kept small. I don't like to have more than 10 in any particular class, or sometimes 20 depending on the experience level we have in them, and because there needs to be one-on-one attention. Out of that, you also get a 30-minute one-to-one session with myself as well. You can ask whatever questions you want in that one-to-one session. And we have a Facebook group. The email that you're going to be getting out is the email that you will get out will show the Facebook group, and you can join that Facebook group. This course has another closed one because we all get really nice and close and personal and we ask questions, but there is a public Facebook group that you could join today if you like, and I'll put that in the email as well. The live and online version is $497. Always, we get 30% off. You get the live and online plus all of the access to the regular classroom as well. So if you want to take advantage of that, you can. All of our webinar specials are only open for 72 hours. So on Monday at midnight, they will close. So there is a little bit of a time deadline. The program that I do is called Entrepreneurial Intelligence, and we have a podcast which is up and coming, which is super cool, super fun, and hopefully it's going to be released in April 2018. If you're on our mailing list, we absolutely will be able to tell you when it's coming. We have some really cool things going in our podcast and some really cool interviews we've had so far. It covers, excuse me, the fundamentals of business all of the material that's in the eSchool will eventually be covered. There's just so many interesting things that we can cover on a podcast. So it talks about things like your credit rating and how being self-employed affects. We cover the technology pieces, which can confuse people. We have an interview with an accountant, which talks about what CRA looks for, how you can red flag yourself. All of the content that's in the eSchool or the Business for Newbies will be covered. We have some guest speakers as well. And we also talk about how to grow your business. And we have a little bit of woo-woo stuff because, you know, I'm a little woo-woo sometimes. So we actually have a podcast event which talks about how spirituality and meditation affects your success as well. So those are some of the things that we've already done with the podcast, and we're super looking forward to releasing that. When you signed up for the webinar, there would have been a box which said, you know, do you want to stay informed? And if you said no, you're going to get information about the podcast, and then it'll be done. You won't hear from us again until the next time you join us for a podcast. But if you really wanted to stay informed about things that we have going on or new webinars coming up, and you think, geez, I wish I had signed up, this is where you go. Go to linweb.ca/join-us, and you can just sign up there, and it'll do the exact same thing. We'll get you on our list. Okay, so Q&A, I have some questions here. Let me just move my technology around so I can address them. Okay. So Allison says, when does all this happen? Maybe Allison, if I can just get you in the chat just to kind of clarify that a little bit, what that question is, and I'll come back to that one. Deborah, what if I don't care about CPP when I retire? Can I just get the CPP 6? Oh, yes, and I didn't tell you about that. I'm sorry. Thank you. That's an excellent question. Yes. The CPP requirements for you to stay qualified, I think it's about $5,800. I always tell people $6,000 because it's a nice round number. You have to take payroll of about $6,000 a year and pay your CPP premiums. That's roughly $250 a year. So if you're set that dividends is what you want, what you do is you have your accountant give you a salary of roughly $6,000 a year, and then you take the remainder in dividends. So that keeps you qualified for CPP. It's $250 of CPP premiums per year, roughly-ish, and or actually just a little bit more than 250, I guess, about 290. And then you take the rest in dividends and you stay qualified. So that was a really good question. Thank you for reminding me. Okay, Allison says, which day? Okay, so what Allison is asking is, when does all this occur? Like, when does everything get filed? And so again, the numbers are happening all year long, whether you're taking payroll or dividends. It happens throughout the course of the year. And then all of the paperwork gets filed in February, which is why I say you got to do that check-in with your accountant in December, because in December, he still has a chance to change it. If you have a bookkeeper, by the way, this is traditionally a bookkeeper's job. Not everybody has a bookkeeper. The accountant will do both. The bookkeeper's job is around the payroll and the T4. The accountant's job is around the T5 and the dividend, which is another reason why sometimes it's disconnected, because you have different people doing it. So check in with the appropriate person. If you have a bookkeeper, start there. If you don't, go to your accountant, check in December, make sure you're on track. Then all year long, whatever decision, if you have a payroll component, it happens all year long, and all of the paperwork gets filed in February regardless. So I hope that helps. Is that what you're looking for? Yes. Okay, good. Peter says, which way do normal people do it? Right. Peter, that's such a good question. Normal people do it all kinds of different ways, but I'll tell you the way that I did it. Now, I do taxes as well. I do personal taxes. I don't do the corporate ones, but I do personal taxes. So the way that I would do it, and I had a year end of April, so I would always check. So it was way far away from when when you're actually doing all the paperwork. So at the beginning of December, what I would do is check in, and I would say, where am I at? And I would open my tax program and run all of the numbers through. So I would say, well, if I'm going to make $50,000, what does that look like? Do I take that as payroll? What's that number? Okay. Do I take that as dividends? What's that number? Okay. So I would run all of those numbers, and then I would pick the option which was the best option for me. And sometimes it was a combination of both. So I actually ended up, my personal strategy for many, many years was I took the first $25,000 as salary, because I was looking at the CPP and thinking, you know, and it was just my strategy. I had some insurance, so I needed to make a little bit of money to kind of stay qualified for stuff. And then I took the remainder in dividends. However, in my opinion, one of the most expensive tax strategies you can get is to have high numbers and take both payroll and dividends. So payroll to $50,000 and dividends to $50,000 is kind of illogical. So you don't really want to split half. You want to understand what your motivation is. So is CPP important? Is workers' comp important? Are RSPs important? Do you have a disability insurance you have to worry about before you rewrite it? Are those important? And if they are, that starts the decision. The second part of the decision is running those numbers and seeing what you pay. That's your accountant's job, by the way. There's no reason you can't go to your accountant and say, here's my money situation from my shareholders loan. Tell me the different tax scenarios. It does not take long, and there's no reason why your accountant shouldn't be doing that for you. So I hope that answers your question. Let me just quickly look through chat. A quick question, and Terry, I'm sorry, I'm not sure I totally understand this, but I'm paying for WCB, but I can't claim it. If you've decided that you want to be covered for, let's say, $50,000 of workers' comp, and you're paying yourself by dividends, you can't claim $50,000. You can claim the minimum of $28,400 in Alberta anyway. And again, I want you to call workers' comp. So if you're concerned about that area, I want you to phone them and I want you to ask them, because they are the professionals, and those rules could change. And I wouldn't know necessarily about the change, you know, immediately. But the way it has traditionally been, you would qualify for the minimum $28,400 and nothing more after that. So a lot of people reduce the amount that they pay because it's just money that kind of goes out the window, and workers' comp will take your money. They're not going to, you know, they're certainly not going to tell you you won't be able to make a claim. But so you have to make that judgment call after you call them and make sure you pay yourself appropriately. I hope that answered your question. Okay, so I have a few minutes. I promised you a bonus. Here's what it is. So, excuse me, we have a module called DoItYourself Bookkeeping. It is module 10 in our ESchool class, and this is one that we give to you for free, just simply for hanging out in our webinar. So the DoItYourself Bookkeeping covers a few things, which is beyond DoItYourself Bookkeeping. I actually don't teach you how to do your own bookkeeping in there. But what we do is we teach you the different types. So there's 2 different styles of bookkeeping, and the way that you do it can make a huge difference in how many taxes you pay and what you see on your financial statement. And a lot of people don't realize there's a couple different types, and they're vastly, vastly different depending on your business. We talk about how to organize your paperwork. So, you know, you have this shoebox. How do you put that all together to make sure that you are staying relatively organized? And the final thing we talk about is a little bit about, should you be doing it or should you need a bookkeeper to do it? So we kind of help you measure in when to make that decision. Sometimes people say, well, I do it myself, but I don't know if I should have a bookkeeper. And sometimes people use a bookkeeper and they don't really need to. So we'll cover that piece of it as well. When you get the link, it's going to take you to this page right here, which asks you to sign up with your account information. Now, all of my products are delivered through another third party. So you have to actually log in, and there's no charge. You just log in and you hit that continue button, and then you'll have access to the course. So that's it. I always want to leave these webinars with a quote. And this is my absolute favorite. It's very well known, but I say a year from now, you'll wish you had started today. And I say that because when it comes to tax, the last thing you want to be doing is reacting right now during tax time for something you should have done last January. Inevitably, that's a formula to pay more tax. So a year from now, when you're doing tax for this year, you'll be like, yes, I did everything right all year. So I want to thank you so much for joining me here. I super, super appreciate it. I always love when I get people who come to the webinars, and I feel so honored when people join me. After this, what to expect, you're going to get an email from us sometime within the next 24 hours, which will give you the replay. It'll give you all the bonuses, everything that you can click on to sign up. And yeah, and join our Facebook group. If you're hanging around, you can ask all of your questions in there. That is all for today. Thank you so much, and we'll see you in the next webinar. This is Lynn Webb. See you later. Bye.